Why is pound sterling to US dollar dropping today? We break down the cable technical analysis, key support at 1.3322, resistance at 1.3351, and the 200-day moving averages role in today's sell signal. Right now, the entire market is watching the same obvious support, and that's exactly why it's about to become a trap. Cable has flushed over 150 pips in 3 days, yet order books show retail is still buying dips. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end, because I'm giving you 3 exact levels you can trade tomorrow, including a sniper entry that only triggers if the whale stops get run. This session, pound sterling to US dollar bias is fading the consolidation with a heavy bearish tilt. Any bounce that fails to reclaim 1.3364 is a reload for the weekly strong sell. The single invalidation level that flips this entire structure is a 4H close above 1.3365. Write that number down. 1.3365. If we get a 4H close above 1.3365 today, the bearish structure resets, and we are looking at a squeeze towards 1.3450. But as long as we stay below that, the path of least resistance is down into the 1.3300 liquidity cluster. Here's what matters. The herd is still positioned heavily long from last week's dip buying above 1.34, and those stops are now sitting right below 1.3320. That's exactly where the market hunts. Let me walk you through the chart stack, and you'll see why this is one of the cleanest bearish alignments we've seen in weeks. Starting on the weekly, the trend is a strong sell. The 200-week moving average is anchored near 1.3385. And price hasn't seen a weekly close above that level since the last Fed decision. The weekly candle is currently carving a bearish engulfing, which tells you institutions are fading any relief rallies. Drop down to the daily, and it's a strong sell as well. The MA20 is at 1.3428, the MA50 at 1.3458, and the MA100 at 1.3444, all stacked like a descending ceiling. Price is trading comfortably below all 3, and the daily RSI is 39, not yet oversold, meaning there's still room to run lower. The daily MACD is printing minus 0.003, and the bearish signal line crossover is accelerating. That's not just momentum, that's sustained selling pressure. Now, here's what most traders miss. 3 o'clock retention bridge. On the 4H chart, we have a textbook hidden divergence. Price has been making lower lows while the MACD histogram is making higher lows. That's a classic bearish continuation signal, not a reversal. Buyers are exhausted before they even test the first resistance. The 5H trend is also strong sell, reinforcing this. As I speak, the 60-minute chart is neutral, with the pair coiling between 1.3343 resistance and 1.3322 support. The MA200 on the 1H is at 1.3385, acting exactly like a brick wall. Every intraday bounce has been rejected there. The stochastic on the 1H is at 40, not overbought, so any pop towards 1.3351 is a potential short entry. The daily support zone is precise. 1.3322 is the first line. In the sand, followed by 1.3309. And then the psychological magnet at 1.3301. Those 3 levels form a liquidity cluster that the market wants to sweep. Resistance above is equally clear. 1.3343 is the 1H pivot, 1.3351 the microswing high, and 1.3364 the local structure ceiling. The cross-asset linkage here is critical. Gold is tick for tick with real yields collapsing, but cable is moving inversely with the DXY, which just printed a higher high on the back of Friday's jobs. As long as the dollar index holds above 103.80, pound sterling to US dollar struggles to find a bid. Yesterday's price action was absolutely a reflection of Friday's blowout US jobs report, which has repriced Fed tightening to around 30 basis points this year and 50 basis points by the second quarter of 2027. Cable barely had a chance to breathe because the dollar's rate advantage is widening again. Sterling and the euro edged marginally higher early today, but that's just a dead cat pause. Underlying dollar demand remains firmly supported. The Bank of England is in a policy divergence battle. UK gilt yields have failed to keep pace with US 10-year yields, and the spread is widening in favour of the greenback. That's the dollar killer dynamic. Pound sterling to US dollar gets crushed when the U.S.UK rate differential moves decisively. And here's the kicker. Equity markets are risk-off, with a tech-led sell-off gripping futures, and that's pushing flows into the dollar as a safe haven. Pound is a risk proxy, so the S&P 500 futures. Correlation is adding another layer of bearish pressure. My 1 to 2 week directional lean is lower, targeting a sweep of 1.3300 and likely an extension towards the 1.3260 demand zone. The exact event that would invalidate this view is a daily close back above 1.3450, or any bow commentary that explicitly pushes back against current rate expectations. For now, the path is down. Do you think the dollar breaks 105 this week? Comment yes or no right now. I'm tracking consensus and will share the poll in tomorrow's video. Most people skip this section. That's exactly where the money is made. Keep watching, because these three setups are mapped to real liquidity levels that the algorithms are tracking. Before I break them down, type your pound sterling to US dollar range for tomorrow in the comments now. Let's see who's aligned with institutional flow. Strategy 1, the sniper, conservative. This is the breakout fade entry for those who want to trade with a strong sell trend but need confirmation that the consolidation has resolved lower. Your trigger condition is a 1H candle close below 1.3320. I'm not selling into the chop. I'm waiting for the liquidity grab below the 1.3322 support to confirm that stops have been run and momentum is building. Once that 1H close prints, you go short. Stop loss is at 1.3355, which sits above the 1.3351 micro-resistance and above today's consolidation high, so you're protected against a false breakdown squeeze. Target 1 is 1.3301, the psychological magnet, for a risk. Reward of 1 to 1.3. Target 2 is 1.3260, which aligns with the next weekly support zone, giving you a 1 to 2.7 reward. This setup is completely voided if we see a daily close above 1.3365. That would signal the breakdown was a trap, and I'd cut any remaining position to the sniper, conservative, entry. 1.3320, 1H close below, stop loss. 1.3355 take profit 1. 1.3301 take profit 2. 1.3260 risk, reward. 1:1.3R. TP1. 1:2.7R, TP2, invalidation. Void if daily close above 1.3365. Strategy 2, the active trader, standard. This is the mean reversion fade for those who want to sell strength rather than chase a breakdown. Right now, the 1H chart shows a tight range. Your entry condition is a pullback to the 1.3350 resistance zone. That's where the 1HMA 200 is descending and where the 5H trend supply sits. You enter short on a bearish rejection candle at 1.3350, with a stop loss at 1.3370, just above the intraday swing high and above the 200-hour moving average at 1.3385. That gives the trade room to breathe without invalidating the broader bearish structure. Target 1 is 1.3309. The secondary support that often acts as a temporary floor during a trend day. Once target 1 is hit, move your stop to entry and let the runner target 1.3260. This way you lock in a risk-free trade and capture the extended move. The trailing stop rule is simple. Once the trade reaches target 1, trail the stop to 1.3335, ensuring you bank profit even if the market whips back to the active trader, standard, entry. 1.3350, bearish. Rejection candle, stop loss. 1.3370 take profit 1. 1.3309 take profit 2. 1.3260, runner with trailing stop to 1.3335 after TP1, risk, reward. 1:2.0R, TP1, invalidation. Void if 4H candle closes above 1.3385. Strategy 3, the aggressor, high risk. This is the counter-trend momentum play for traders who can handle a tight leash and want to profit from a violent liquidity grab. The idea: if price spikes into the 1.3300 to 1.3301 support zone and fails to hold, It could engineer a stop run followed by a sharp reflexive bounce as late shorts get trapped. Your entry is a long at 1.3295, only after a 15-minute bullish engulfing pattern prints off the 1.3300 level. This is not a blind bid, it's a trap trade. Stop loss is extremely tight at 1.3285, just below the spike low, giving you a 10 pip risk. Target 1 is 1.3340, back into the midpoint of the prior range, yielding a 1 to 4.5 reward to risk. Target 2, if momentum is fierce, is 1.3360, right below the structure ceiling. But listen carefully. This trade is only valid if the move occurs within the first hour of a London or New York session with a notable volume spike. No momentum, no trade. Only for those who can lose small and manage risk aggressively. If you hesitate, this setup will eat you to the aggressor, high risk, entry. 1.3295, 15M bullish engulfing off 1.3300, stop loss. 1.3285 take profit 1. 1.3340 take profit 2. 1.3360 risk, reward. 1:4.5R, TP1, invalidation. Void if 15M close below 1.3285 or lack of volume surge. Never risk more than 1.2% per trade. No positions through high impact news, especially with US claims data due later this week. Stops are non-negotiable. This is how you survive to trade the next big move. If you're sizing these three setups together, reduce total risk so that no single session wipes out your edge. So the single most critical level for the next session is 1.3300. If we get a decisive 4H close below that level with volume, the bear trend accelerates and the target shifts to 1.3220. Tomorrow's wildcard, US CPI revisions and any Bank of England speaker that could shift the rate cut narrative. I'll be dissecting that live, because the market is still underpricing the UK's own growth weakness. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live right now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one. Same time, same sniper precision.